Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first IMF warns UK faces G7's highest inflation despite growth as AI bubble risk now exceeds dot-com peak. We'll explore how this stagflationary trap complicates Bank of England policy while a potential AI-driven market correction threatens global financial stability. Second, Argentina's President Milei achieves first fiscal surplus in 14 years with shock therapy, securing a $20 billion US currency swap. So we'll discuss why this radical economic experiment has won Washington's backing and what it means for investors betting on Milei's political survival. Third, JPMorgan's Jamie Dimon warns of cockroaches in the $2.5 trillion private credit market after booking a $170 million loss on auto loans. We'll examine how this warning signals the end of a 14-year credit boom and how it could trigger a preemptive credit tightening across Wall Street. The International Monetary Fund just dropped a report on the UK economy, and it's a study in sharp contrast. The headline, the UK is set to be the second fastest growing economy in the G7 this year. But the knockout punch is hidden in the details. The very same report forecasts the UK will also face the highest inflation among all G7 nations in both 2025 and 2026. When you see strong growth alongside stubbornly high inflation, that's a classic warning sign of a stagflationary trap. You see, these two numbers are telling very different stories. Inflation is what economists call a lagging indicator. It reflects past pressures, like last year's energy prices, but the real-time health of the economy is much weaker. But that's not the whole picture. The positive headline starts to unravel when you measure economic output on a per-person basis. On that metric, the UK plummets to the absolute bottom of the G7 league table with growth of just 0.4%. This per-person growth figure is crucial because it's a much better coincident indicator of what's happening right now. It shows the headline growth isn't actually translating into improved prosperity for the average person. This is why the UK's own Chancellor, Rachel Reeves, stated bluntly, for too many people, our economy feels stuck. The opposition shadow chancellor went further, calling the assessment grim reading for households being squeezed from all sides. And, this stuck feeling has deep roots. Research shows that since the Brexit referendum, business investment in the UK has been persistently weak, lagging far behind other G7 countries. When companies stop investing in new machinery, technology and buildings, it puts a structural cap on growth, making the entire economy more reliant on consumer spending and more vulnerable to shocks. This tension isn't just a UK problem, it's a global warning siren. The IMF report flags a world economy where resilience is giving way to warning signs. It points to the impact of US tariffs, ongoing geopolitical risks, and sky-high valuations of US tech companies. A while back, we flagged a fascinating duality here. The Bank of England's stability watchdog cautioned that AI-driven tech valuations appear stretched. Even as central banks trimmed dollar reserves, IMF COFA data showed a fall from 59% to 55% in a single quarter and helped set a higher floor under gold. That split frothy tech versus rising safe haven demand frames, exactly the fragility the IMF is pointing to now. Now, about those US tariffs. The risk for an open economy like the UK isn't just about being directly targeted. The IMF's analysis shows that the ongoing US-China trade friction is causing global economic fragmentation. This could slow down key UK trading partners like the EU and the US, derailing the UK's own fragile growth forecast no matter what it does domestically. The Bank of England has been warned directly by the IMF to be very cautious about cutting interest rates. As we noted before, the BOE's own Financial Policy Committee has also warned about stretched AI valuations, another reason rate setters are wary of easing into a potentially unstable market backdrop. The reason for this urgency is that global inflationary pressures are overriding the UK's domestic signs of a slowdown. By comparison, while EU inflation sits at 2.4%, the UK's is forecast to remain much higher, around 3.8%. This forces the Bank of England into a policy bind. If it cuts rates while the US Federal Reserve and European Central Bank do not, it could weaken the pound. But if it keeps rates high to fight inflation, it risks higher mortgage rates for homeowners and a stronger pound that hurts exporters. Continuing our last discussion about stretched AI valuations and .com parallels flagged by the BOE, the latest development is this. The most chilling warning is aimed squarely at the markets. The IMF says there are excessively optimistic expectations around AI that could trigger a correction and that markets appear complacent. The final jaw-dropping fact, the concentration of overvaluation in today's tech stocks is now substantially higher than it was at the peak of the dot-com bubble. What's so jarring is that the IMF is signaling a direct threat to financial stability that goes far beyond a simple stock market dip. A sharp correction in US tech stocks could trigger what's known as a global risk-off event. This would tighten financial conditions everywhere, including in London. This is significant because many UK pension funds have huge exposure to these same US tech giants. A crash in that sector could directly impact the retirement savings of millions, regardless of how the UK's domestic economy is performing. A few days ago, we also talked about how a correction could spur a capital rotation out of tech and into gold, combined with central banks' ongoing move away from the dollar and the Fed credibility risk premium we discussed. That rotation would amplify the very tightening the IMF is warning about, even if the UK's domestic data looks steady. The world's financial watchdog is signalling that while some economies look strong on the surface, major risks are building just below. While the IMF is warning about hidden fragility in major economies, let's turn to a country embracing economic risk head-on. The most unexpected news in global politics today has to be that Argentina's president, Javier Milei, a world leader famous for brandishing a chainsaw at his rallies, just delivered his country's first fiscal surplus in 14 years. In Argentina, he has taken a blowtorch to the economy. Before he took office, inflation was a catastrophic 211%. Today, it has tumbled to roughly 36%. So the thing is, this rapid drop in inflation wasn't magic. It was actually achieved through a severe policy-induced recession. Economists call this shock therapy. By drastically cutting government spending and tightening the money supply, Milei deliberately cooled down the overheated economy. The drop in demand was so sharp that prices had no choice but to stop rising so quickly. This is the brutal trade-off at the heart of his plan. This radical shock therapy has won him powerful allies. Donald Trump calls Milei my favourite president, and some UK conservatives see his plan as a template. However, if you zoom out, you'll see a critical piece of context that makes comparing Milei's Argentina to Margaret Thatcher's UK in the 1970s misleading. The key difference is the starting point. The UK faced stagflation, high inflation plus slow growth. Argentina, by contrast, was in a state of hyperinflation. Milei's success in achieving a fiscal surplus was directly helped by this hyperinflation, which effectively erased the real value of government debts and fixed peso expenditures. It's a unique condition that simply didn't exist in the UK or the US, making the template idea a very flawed comparison. Washington just backed a $20 billion currency swap to prop up the peso. A while back, we broke down how Washington tapped its emergency playbook, the Exchange Stabilization Fund, to move fast without a congressional vote, and even signaled readiness for whatever exceptional measures are warranted. So while Treasury officials now stress the swap line mechanics rather than a simple handout, the through line is the same: guaranteed dollar access to steady a crisis-prone currency delivered at speed. Now get this, a currency swap isn't a handout or a loan. As the US Treasury Secretary clarified, they are not just throwing money into Argentina. Instead, it's a swap line, an agreement where the central banks can exchange their currencies. This gives Argentina access to a stable supply of US dollars to defend the peso and manage financial stress. Believe it or not, this is the most aggressive US intervention in an emerging market currency since the 1995 Mexico crisis. Some analysts are calling this a geopolitical Trump put, suggesting that support is tied more to ideological alignment with the US than pure economic fundamentals. And as we noted a while back, that bet is already sparking blowback in Washington. Democratic critics blasted the move as helping abroad while Americans struggle at home. And even farm state Republicans questioned why you'd bolster a country that competes with US soybean producers. That's the geo-economic paradox shore up an ally. And you may also boost its ag exports to China at the expense of your own base. This is where the situation takes a more complex turn. Milei promised the pain would be felt by the political elite, a group he calls the caste. Instead, critics say the adjustment was directed at the working classes. On the streets, protests have been met with tear gas and rubber bullets. The cost is staggering. Milei halved government ministries, cut tens of thousands of public jobs, and slashed subsidies, causing utility and transport prices to skyrocket. Argentina's textile industry alone reports losing more than 10,000 direct jobs after Milei cut import tariffs. And here's the economic logic behind those job losses. By unilaterally cutting import tariffs, Milei opened the floodgates to foreign goods. The data shows this clearly. In just one recent month, imports surged by over 32% year on year. This created what local industrial leaders call unfair competition, squeezing domestic producers out of their own market. For a country like China, this policy shift is a double-edged sword. While it might open a new market for Chinese exports that are facing tariffs elsewhere, it also serves as a stark warning about the social and industrial costs of rapid, unprotected trade liberalisation. One tea farmer, whose family business has lasted 3 generations, says he had to close his payroll completely and now has 0 employees. This has created a dangerous paradox. While foreign investors cheer the macroeconomic numbers, they are spooked by the country's growing instability. And remember, as we discussed earlier, a specific breed of hedge funds piled into the Argentina trade on the assumption that reforms plus a US backstop would cushion the downside. That safety net only works as long as political risk doesn't overwhelm the math. In a fragile state like Argentina, what's really at play is that political sentiment can be a more powerful market indicator than economic data. Investors are now watching President Milei's approval ratings as a crucial leading indicator for the country's asset prices. His support is still relatively robust, hovering around 50%, but any significant drop could trigger a sell-off in Argentine bonds and the peso. Regardless of what the inflation numbers say, it shows the entire IMF-backed program rests on his ability to maintain popular support. With midterm elections looming, Argentina is a nation divided. The international praise is built on a fragile foundation of public tolerance. If the people lose faith, the markets will follow, and this entire economic experiment could unravel. So, what should we watch for next? A while back, we told you to track monthly inflation and the fiscal balance. Keep those on your dashboard. Today, add 2 more. First, keep an eye on Argentina's monthly economic activity indicator, known as the EMAE. This will give us the first signal of whether the deep recession is bottoming out. Second, and perhaps more importantly, watch Milei's approval ratings as the 2025 midterm elections get closer. The international financial community is split, with the OECD forecasting a strong 5.2% rebound for Argentina, while the IMF is more cautious, downgrading its forecast to 4.5%. For commodity watchers, the soybean angle we highlighted remains live. If Argentina's export engine revs, the political backlash in Washington could intensify. Ultimately, the fate of Argentina's economy may be decided not just in the financial markets, but on the streets and at the ballot box. From a political leader trying to manage a national crisis, we turn to a financial titan who's warning a new one might be brewing. The CEO of America's largest bank, JPMorgan Chase, just dropped a chilling warning on Wall Street. His words? When you see one cockroach, there are probably more. The cockroach Dimon is referring to is so significant because it points to a potential crack in a massive and often hidden part of the financial system. We're talking about the private credit market. This market involves non-bank institutions lending directly to companies, and it has exploded in size, growing from around $300 billion in 2010 to over $2.5 trillion today. This is a huge pool of money, larger than the entire high-yield bond market, and it operates with much less transparency than traditional banking. So when a cockroach appears here, it's scary because no one knows exactly how many more are hiding in the dark. Jamie Dimon is talking about the sudden collapse of 2 companies in the auto market, parts firm First Brands and subprime lender Tricolor Holdings. These aren't just isolated failures, they are a direct hit to the banking system. JPMorgan itself just booked a $170 million charge off from the Tricolor collapse, a loss Dimon bluntly called not our finest moment. Here's where it gets interesting. The auto industry is often seen as the canary in the coal mine for the economy. Its health is a direct reflection of both consumer finances and manufacturing strength. stress in subprime auto loans, like with Tricolor, is a big deal because it often signals that the most vulnerable consumers are in trouble. At the same time, the failure of a part supplier like First Brands points to deeper issues. In fact, First Brands' problems have been explicitly linked to supply chain pressures caused by the Section 301 tariffs on Chinese imports. This shows how geopolitical trade policy is now directly triggering corporate credit failures, forcing investors to reevaluate the risk for any company with a US-China supply chain. But the rabbit hole goes deeper. This problem has ensnared a whole constellation of major banks. The investment bank Jefferies says its funds are owed $715 million. UBS has about $500 million in exposure, and regional bank Fifth Third Disclosure expects up to $200 million in impairments from alleged fraudulent activity tied to one of the borrowers. When we place JPMorgan's manageable $170 million loss alongside the billion-dollar-plus exposures at Jefferies and UBS, the underlying dynamic becomes clear. It reveals a huge shift in the financial world. Over the past decade, a lot of risk has moved away from the balance sheets of traditional banks and into these less visible, less regulated investment funds. This is a classic case of what experts call regulatory arbitrage, moving risk to where the rules are looser. The danger is that systemic risk can build up unseen by regulators until it's too late. This all begs the question, what's the real end game here? According to Dimon, this is about far more than just the auto market. He says we've been in a credit bull market for nearly 14 years, and these bankruptcies are the early signs that corporate lending standards grew far too lax. The timing of this warning is no accident. After all, when Jamie Dimon speaks, Wall Street listens. This isn't just a casual comment. It's a strategic signal, similar to when a central banker tries to guide the market with words alone. It's worth remembering that back in 2007, Dimon was one of the few major bank CEOs to publicly warn about rising mortgage defaults right before the 2008 financial crisis. By sounding the alarm now, during a quarter of strong earnings, he may be trying to force a preemptive tightening of credit across the industry, hoping to cool things down before they boil over. While JPMorgan itself posted strong earnings this quarter, the questions on everyone's mind were about these shocking credit losses. Dimon's message was a direct shot across the bow for the entire financial industry, a warning that if the economy takes a downturn, we are going to see a lot more credit issues. So, what should we watch for next? The key will be to monitor corporate default rates and delinquency rates, especially in the auto loan sector. If these numbers continue to climb, we could see a rapid tightening of credit. For the markets, this could mean more volatility for stocks as borrowing gets more expensive for companies. For the real economy, it could slow down investment and hiring. The final word from the top of Wall Street is a stark one. After years of easy money, everyone should be forewarned.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.